Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, in the last week, not a lot has gone on in investment markets. In fact, if you grab your phone and you look at your stock app, whichever one you use, and look at, say, the FTSE 100 or the FTSE 250, or even if you want to look at an American index in the S&P 500 or even the Nasdaq 100, what you'll notice is that after the initial Pfizer vaccine, so if you go back to the 6th to the 10th of November, you will see that the markets had a strong rally. So on the 9th of November, Pfizer announced its vaccine news, which obviously shook up markets. And you'll see there were really strong moves around that time and the days just after. But if you zoom out and look what's happened since that date, in the last couple of weeks, markets have been fairly flat. They've not been aggressively moving upwards. It's been net positive for stock markets, but in the last week, we've seen periods of gains and pullbacks. I mean, in the S&P 500 in America, we broke above 3,600. We set new all-time highs. We saw the same thing in the Dow Jones, which broke above 30,000 for the first time. So all of this is good news for stock markets. And in the UK, the FTSE 100 continued to perform very well, although we've seen it now pull back down towards about 6,400. But we've seen those rotations still occur within markets, but not to the same degree or aggressiveness. So where we saw small caps massively outperforming large caps, where we saw cyclicals outperforming things like growth, particularly tech stocks, that's been a little bit more muted, which is still there in the background, which is why it's been net positive for equity markets, because what's happened, these sectors that were unloved are playing catch up, while those that were obviously the best plays during the height of the pandemic may have initially lost a bit of value, but have been supported. So the market's kind of caught up, and that has allowed the overall wider indices to rise higher, while there's been a little bit of rotation within those sectors. But as I mentioned there, what is interesting is that if you look at some of those pandemic plays, those stay-at-home plays that have done so well, and that would include technology stocks, some of the large caps, they've actually held their support levels. We saw Apple obviously sell off and it has pulled back, but held its uptrend line. We saw that in technology stocks too. So some of those work-from-home plays that have done very well, that have since lagged during November, which has been one of the best months for equity markets more widely, they have shown signs of support, which does suggest that perhaps the market isn't ready to completely go two-footed in on the rotation trade and obviously the vaccine news. As I mentioned last week, we've seen the market's reaction to each piece of vaccine news, whether it's an update on the latest vaccine, whether it's an update on the existing vaccine and the effectiveness of it. The market's reaction has been less and less aggressive. It's been more muted, and we've seen that in bond markets. If you look at the 10-year US Treasury yield, that's pulled back a bit. We're at levels now that are just above where they were pre the Pfizer vaccine. The same can be said of the 10-year gilt yield, and part of that is because obviously we're seeing record numbers of coronavirus cases in the UK and around the world. We're seeing some lockdown restrictions ease, but obviously in the UK they are still pretty draconian in the lead up to Christmas. So we've also had the news from the Chancellor about his spending review, but in that he also talked about the outlook for the UK economy, and actually we're going to have one of the worst periods in 300 years. And 300 years, that's a long time. I mean, comparing what happened 300 years ago to today is quite some comparison. So you can see there's a lot of headwinds still for the economy, and obviously the vaccine news is positive. So while the rotation trade is still ongoing, it's not as aggressive. And what we're seeing is markets being largely flat this week, and some of those rotations have given back some of their gains, and we've seen some of those things from the pandemic period start to pick up slightly. But don't forget, it's Thanksgiving in America, so markets are always slightly thin at this time of year, which means there's less trading going on, so we don't necessarily see huge amounts of money being bet on anything in particular. Now, if you look at the pound, what's quite interesting, the pound is elevated at the moment. And I think for UK investors, that's having quite an impact on portfolio. So we're seeing up around about $1.33, pushing towards $1.34. Now, that increase in the value of the pound versus the dollar has been driven by optimism surrounding an agreement between the UK and the European Union over Brexit, effectively. And of course, we've also seen the dollar weakening, so that combination has seen the pound rally. Now, if you have overseas assets that are denominated in dollars, that's going to hurt your portfolio. So that would have hurt anybody who's been in, say, large US tech companies in the last month. They would have seen the impact of the rotation trade plus the currency move hamper portfolios, but you wouldn't have necessarily lost money. You would just maybe not have made much money as other people who were invested in, say, the FTSE 250, for example, because there's no currency exposure and it's also benefited from that rotation trade. But keep an eye on that, because although there's a feeling that a lot of the good news surrounding a potential deal with the UK and the European Union is already priced in, what could happen if there is an accidental no deal, which I always find quite a funny phrase, an accidental no deal. We have gone into this seemingly with our eyes wide open. Then we could see an aggressive move on the pound, which would have a huge impact on portfolios for UK investors. So keep an eye out on that. Now, we are heading towards Christmas, so after Thanksgiving, it'll be interesting to see what starts to happen with the various asset classes out there. I mean, technology stocks have been one of the biggest beneficiaries from the Santa rally, that seasonal trend that is usually positive for equity markets heading into Christmas. So, although the Nasdaq 100 is a laggard in November, which is an incredibly unusual thing to say, I mean, to think that we could be in a position where we're talking about the unloved Apple or Facebooks of this world, the unloved tech giants, compared to things that were pretty much anything else, smaller caps, airlines, you name it, they're being bought en masse during November. They're unloved. Could we see a bounce from those support lines into Christmas? I mean, seasonality is definitely in their favour. But one of the other assets I wanted to quickly talk about is gold. Now, gold, we've seen quite an aggressive sell-off, pushing down towards the $1,800 mark. And there'll be people wondering if this is it for gold. Is it all over, the rally that we've seen? Now, a lot of the rally we've had since the summer has been given up. But it's at another crucial support level. But like I said, some of those key pandemic trades, gold is at the key support level. If we break down below that $1,800 mark, then things could unravel. And there's been a lot in the press actually about Bitcoin. So people are saying that Bitcoin is the new gold. So people would be thinking with the dollar weak, you'd buy gold. But obviously gold's been underperforming and people would be buying Bitcoin. That's the narrative. But then just as Bitcoin is threatening to push up towards its own all-time highs, it's then corrected more than 10% in a single day. So it just goes to show you that no asset is safe from these violent moves that we're seeing in markets. And it's all down to sentiment. Sentiment's important in this market. And if we get a shift in sentiment away from the vaccine news and we're all coming out of this in a positive way and back into lockdowns and pessimism over the economy, we could see those rotations all unwind and we could see more support for the stay-at-home trade. But to sum up, at the moment, equity markets technically are in a very positive space. Particularly when you look at things like the number of stocks within individual indices that are setting new highs or breaking above 200-day moving averages. That'll be something I'll come back onto in a future episode. So that is it for this week on Damien's Midweek Market. As ever, you can contact me, Damien at moneytothemasses.com is the email address. Twitter, moneytothemasses with the number 2. Instagram, Facebook, as usual. And of course, don't forget to subscribe to our YouTube channel.